Hello, hello, hello. Welcome back to our Auditing Theory Marathoners. You're still here in Let's Talk Audit and Assurance and currently in the MCQ Marathon playlist where we are about to enter the last leg of round three for our MCQ Marathon where we help you crack the audit code with questions for board exam preparation. Now, if these marathons have been helping you somehow in your exam preparation, please send us some love by hitting that subscribe button and that notification bell. And please do not forget to give us a like in this video. Now, for those of you who are not quite familiar with how our marathons work, each round of marathon or each round of multiple choice questions per marathon is actually made up of a total of 100 questions. Now, in order to make sure that these are digestible, we have divided this 100 questions into 25 questions per part. Meaning to say, since we are in part 4, once you're able to complete this one, and if you have been religiously following parts 1, 2, and 3 of round 3, then completing part 4 would mean you have already ticked off a total of 100 questions for auditing theories. So let's begin. 25 questions, one goal, CPA success. Our first question is, when events or conditions have been identified which may cast significant doubt on the entity's ability to continue as a going concern, the auditor shall, and we are now going to choose the incorrect statement. Okay, so the instruction is for us to choose the incorrect statement. Letter A, obtain sufficient appropriate evidence to determine whether or not a material uncertainty exists through performing additional audit procedures, including consideration of other mitigating factors. Now, is letter A correct statement? The answer is yes, it is a correct statement. When we have identified events or conditions that cast significant doubt, we do have to obtain sufficient appropriate evidence regards it. Meaning to say, we do have to perform an extra bit of investigation or further inquiry into this significant doubt. Okay, letter B, evaluate management's plans for future actions based on its going concern assessment and whether the outcome of these plans will improve the situation and obtain sufficient appropriate audit evidence that management's plans are feasible in the circumstances. Now, whatever management plans to do with a possible identified significant doubt on its going concern ability are also what we consider to be mitigating factors. Meaning to say, does management have plans in order to somehow lessen the impact or maybe even remove the doubt, right? And letter B is again another correct statement. How about letter C? Letter C says determine whether additional facts or information have become available since the date on which management made its assessment. And this is a very clever way of reminding us that it is actually management who performs or who makes the going concern assessment. The auditor simply looks at whether the assessment made by management is reasonable in the circumstances. And letter C is also a correct statement. This will lead us then with one final possible answer to this question, and that should be choice D, not request specific written representations from management regarding its plans for future action, because we do have to request the said written representations in order to provide a basis or evidence for the mitigating circumstances that we have identified. Okay, so the answer to this is delta. Next, a written representation from a client's management that, among other matters, acknowledges responsibility for the fair presentation of financial statements should normally be signed by in other words, who signs the general written representation of management? Is it letter A, the Chief Executive Officer and the Chief Financial Officer, or letter B, the Chief Financial Officer and the Chair of the Board of Directors, or letter C, the Chair of the Audit Committee of the Board of Directors, or letter D, the chief executive officer, the chair of the board of directors, and the client's lawyers? So, who signs the representation letter? The CEO and the CFO, the one with the overall responsibility for both the operations and the financial management of the client. So, that shall be alpha. Next, the auditor issued a qualified opinion covering the financial statements of a client or of client A for the year ended December 31, 2021. The reason for the qualification was a departure from general accepted accounting principles. In presenting comparative statements for the years ended December 31, 2021 and 2022, the client revised the 2021 financial statements to correct the previous departure from GAAP. So, meaning to say, the client was already able to correct the financial statements of last year. the auditor's 20x2 report on the 20x1 or December 31 20x1 and December 31 20x2 comparative financial statements will, okay, so let's simplify this story a bit. So the auditor is presenting an audit report for comparative financial statements. So if you get to see the FSS, you have there a column for the 20x1 and another column for the 20x2. 20x2 being, of course, the current period under audit. Now, previously, the 20x1 financial statements were given a qualified opinion. However, this year, while it is being presented already in comparative form, the client already corrected the source of the qualification. Meaning to say, when you now look at the comparatives, then even the 20x1 is already stated in its correct, or the 20x1 has already been corrected by the client. So you now see two columns in one financial statement, two columns of both correct figures, if we may. All right. So what will now happen to the audit report on the comparative FS? Is it letter A, express a qualified opinion on the 20x1 financial statements and an unqualified opinion on the 20x2? But we have to remember this time the 20x1 has been corrected already. Okay, how about letter B? Express unqualified opinions on both 20x1 and 20x2 financial statements. Or letter C, retain the qualified opinion covering 20x1, but then add an explanatory paragraph describing the correction of the prior departure from GAAP. So we're still going to retain the qualified, but we will be informing the readers that management has already corrected it. Or letter D, render qualified audit opinions for both, given the 20x2 carryover effect of the 20x1 error. Okay, so again, we have to appreciate the fact that the comparative financial statements are now containing, or now both contain, correct figures, correct disclosures, correct amounts, and so therefore it is only right for the auditor to already express an unqualified opinion on both the 20x1 and the 20x2 financial statements. The auditor may, however, decide to add additional paragraphs, such as an other matter paragraph, in order to highlight the change in the opinion of the 20x1 financial statements, and even the presence of an EOM or an emphasis of matter paragraph to point to a note disclosure that perhaps describes the correction or the effects of the correction of the said error. Okay, but in terms of the opinion, it will now register both unqualified opinions as the 20x1 has already been corrected. Okay, so bravo is the answer to this one. Let's move on to the next question. Morgan CPA is the principal auditor for a multinational corporation. Now, there was another CPA who examined and reported on the financial statements of a significant subsidiary, or we can call it a component of the corporation. So, Morgan is satisfied with the independence and professional reputation of the other auditor, as well as the quality of the other auditor's examination. With respect to Morgan's report on the consolidated financial statements taken as a whole, Morgan, so here we have two characters. The first one is Morgan, who is the principal auditor, otherwise called as the group auditor. And then we have the other auditor. In this case, this other auditor has no name. So this other auditor may also be referred to as the component auditor or simply the other auditor. Okay, now Morgan is going to issue a report on the consolidated financial statements. Thankfully, Morgan is satisfied as to the quality of the other auditor's examination. So what must Morgan do? Now, according to our ISAs, our International Standards on Auditing, the principal auditor or the group auditor must not make a reference to the other auditor. In other words, division of responsibility is not allowed in the ISAs. So therefore, if Morgan is the principal auditor, then it will only be Morgan who will appear in the audit report. Morgan cannot divide the responsibility. Morgan cannot make a reference to the other auditor. Now, we have to be very specific about this one. This is a requirement of our ISAs. In the Philippines, this is also what we follow in our PSAs. But for other jurisdictions and some other countries, they do allow division of responsibility as per accordance with their local auditing standards. Okay, so that is why sometimes you will get to see examples of audit reports which would state we have audited XYZ consolidated except for subsidiary A, which is audited by another auditor. So if you see an introductory paragraph similar to that, In the Philippines, and for those who are fully adapting the ISAs, that is not allowed, as we do not allow division of responsibility. But for other countries, their local audit standards may allow them to do so. Okay, so just as a heads up, in case you have been reading books or review materials authored, for example, in the US, so they do allow a division of responsibility there. But here, we do not refer to the examination of the other auditor. So the answer is alpha. Next, let's talk about Doe. So, Doe, an independent auditor, was engaged to perform an examination of the financial statements of Ali Incorporated 1 month after its fiscal year has ended. Although the inventory count was not observed by Doe and the accounts receivable were not confirmed by direct communication with the debtors, Doe was able to gain satisfaction by applying alternative auditing procedures. With this, Doe's audit report will probably contain letter A standard unqualified opinion, letter B, an unqualified opinion and an emphasis of matter paragraph, or letter C, either a qualified opinion or a disclaimer of opinion, or letter D, an except for qualification of opinion. Now, we do have to take note that while Doe was not able to observe the actual count nor send a confirmation request, Doe was able to perform alternative auditing procedures, and Doe was satisfied with the results of these alternative procedures. So, in this case, then, the correct answer is a standard unqualified opinion will be given by Doe. Let us now move on to our next question. A CPA engaged to examine financial statements observes that the accounting for a certain material item is not in conformity with generally accepted accounting principles. However, this fact is prominently disclosed in the notes to financial statements. So here we have the case of a client who has violated the accounting standards but was honest enough to disclose the violation in the notes. The bigger question now is, will disclosure of a mistake cure the mistake? Okay, so in this case, what should the CPA do? The CPA should, letter A, express an unqualified opinion and insert a middle paragraph emphasizing the matter by reference to the footnote. Or letter B, disclaim an opinion. Or letter C, not allow the accounting treatment for this item to affect the type of opinion because the deviation was anyway disclosed. Or letter D, qualify the opinion because of the deviation from generally accepted accounting principles. Again, we go back to the question, does disclosure of the violation cure the violation? The answer is no. And so, therefore, the mere fact that the client has violated the standards, has disclosed this violation, but still has refused to correct it, this will still reveal, this will still lead to a modification of an opinion. So that's why the auditor will qualify the opinion. Disclosure of a mistake does not necessarily cure the mistake. Okay, so delta for this number. Next, in which of the following circumstances would an auditor most likely add an emphasis of matter paragraph to the auditor's report while expressing an unqualified opinion? So, to this, we do recall our additional paragraphs. We have our EOM, or the emphasis of matter paragraphs, and our OMs, or the other matter paragraphs. Paragraph. Taking into consideration that an EOM is used when the auditor wishes to highlight something found in the notes to financial statements, while an OM is used when the auditor wishes to highlight something that is not found in the notes to financial statements but which is still considered relevant. For example, the presence of another auditor that audited the previous period, or the fact that the previous period was unaudited, among other things. Okay, so which of the following will we most likely see or use an emphasis of matter paragraph? Is it letter A, there is a substantial doubt about the entity's ability to continue as a going concern? Or letter B, management's estimates of the effects of future events are unreasonable? Letter C, no depreciation has been provided in the financial statements? Or letter D, certain transactions cannot be tested because of management's records retention policy? do remember that when you use an EOM or an OM, it does not have the power to modify your opinion. Meaning to say, those which are covered by emphasis of matter paragraphs should neither be violations of the standards nor scope limitation. Because if it's a violation of the standard or if it's a scope limitation, it will lead to a modification of the opinion depending on the effects. All right. So if we're going to evaluate our choices, we will get to see that Bravo, Charlie, and Delta are all either violations or this scope limitation. So Bravo and Charlie, for example, are violations. Delta, for example, is a scope limitation. So we can only issue an unqualified opinion with EOM amongst the four choices in letter A. If there is a substantial doubt and the substantial doubt has been correctly accounted for and disclosed, then in effect, there will be an unqualified opinion and an emphasis of matter paragraph. So alpha for this number. Moving on to our next question, we now go to PSA 720, which talks about the auditor's responsibility when the audited financial statements and the audit report is included in other information. So PSA 720 states, if on reading the other information, the auditor identifies a material inconsistency, the auditor should determine whether the audited financial statement or the other information needs to be amended. So, what type of opinion should be expressed if the client refuses to make the necessary amendment in the financial statements? Meaning to say, upon investigation of the inconsistency, it was found out that the error lies in the financial statements. And we ask the client to adjust the financial statements, but the client refuses to correct or to make the necessary adjustment. What should the auditor do, or what type of opinion should the auditor express? Is it letter A, a disclaimer of opinion, letter B, a qualified opinion or disclaimer of opinion, letter C, an unqualified opinion with an emphasis of matter paragraph describing the material inconsistency, or letter D, qualified or adverse opinion? So to this one, we do take note that it is the financial statements which contain the error, and it is the financial statements which are covered by the auditor's opinion. And so therefore, if there is something wrong in the financial statements and the client refuses to correct it, meaning to say the auditor was able to identify already that there is an error or a violation in the FS. Therefore, the auditor's option will only be either to issue a qualified opinion or an adverse opinion. It cannot be a disclaimer of opinion as there is no scope limitation. The auditor was able to identify the misstatement or the violation. Okay, so it's only either qualified or adverse. Take note again that the error is in the financial statements. Had the error been in the other information, meaning to say, upon investigation of the inconsistency, we saw that the FS is correct, the error lies with the other information, then, had that been the case, the answer would have been letter C. No, it would have been letter C. You would have still given an unqualified opinion because the FS is correct in the first place, but you would like to highlight, okay, the presence of this inconsistency by an additional paragraph. The additional paragraph could either be an other matter paragraph if you would simply like to highlight the inconsistency, or if it is yeah, another matter paragraph or an additional paragraph. Yeah, so the answer to this one, because the error is in the FS, should be delta. Next, let's talk about the framework for comparatives. So we have two broad financial reporting frameworks for comparatives. We have what is called the corresponding figures, and we have what is called comparative financial statements. So the key to remember here is when you talk about corresponding figures, they are an integral part of the current period, meaning to say they will not make sense if they are not read together with the current period. In other words, they cannot stand alone. Corresponding figures are dependent, they are clingy to the current period. Comparative financial statements, on the other hand, they are standalone or separate financial statements presented for purposes of comparison. So the comparative financial statements are our strong independent FSS. Okay, they will make sense with or without the current period. Okay, so because the corresponding figures are part and parcel of the current period, they do not have an identity of their own, the auditor only gives an opinion on the current period. There is no specific reference to the corresponding figures because, for all intents and purposes, they are one and the same with the current period. However, in the case of comparative financial statements, because they are standalone financial statements, they are independent financial statements, when the auditor issues the opinion, the auditor makes a specific reference to each period presented comparatively. So that will be for comparative FSs. So anyway, the question is, which of the following is correct concerning these reporting frameworks? Let us now evaluate our choices. Letter A says, under the corresponding figures framework, the corresponding figures for the prior periods are considered separate financial statements, and this is not correct because corresponding figures, they are part and parcel. They're integral to the current period. They cannot stand alone. So therefore, they are not considered separate. So not letter A. Letter B, under the comparative financial statements framework, the comparative FS of the prior period are intended to be read in conjunction with the amounts and other disclosures related to the current period. This is also not correct because if they are intended to be read together with the current period, then that must make them corresponding figures and not comparative FSs. Letter C, under the comparative financial statements framework, the amounts and other disclosures of the prior period form part of the current period FS. And again, this is not correct because if you're talking about comparative financial statements framework, they stand alone. They are independent, so they do not form part of the current period. They really are presented in their own period or time frame. Okay, so letter C is also incorrect. Therefore, the only correct statement we have here is letter D. Under the corresponding figures framework, the corresponding figures for the prior periods are an integral part of the current period financial statements. So this shall be delta. Next, addition of an emphasis of a matter paragraph to what remains an unqualified opinion is most likely for which of the following situations? Is it letter A, an uncertainty, letter B, a scope limitation, letter C, a misstatement, or letter D is all subsequent events? Now, previously we have mentioned whatever is the subject of an EOM should neither be a scope limitation or a violation or misstatement, right? Because if it's a scope limitation or a violation or misstatement, then it will lead to a modification of opinion. And EOMs, they do not have the power to modify the opinion. So it's not Bravo, it's not Charlie. The question now is, should it be for letter A, an uncertainty, or letter D, all subsequent events? The answer to this one is letter A, an uncertainty, such as, for example, in the case where there is significant doubt on the entity's ability to continue as a going concern. So, not all subsequent events will be the subject of an emphasis of matter paragraph. Now, just as a segue, let us be reminded as well that in our ISAs and our PSAs, our auditing standards, the presence of a material uncertainty or significant doubt relating to the going concern of the client, they used to be covered by just a generic emphasis of matter paragraph. So before, we used to use just an EOM, so emphasis of matter dash going concern. But right now, they do have their very own version of an EOM that we call the MURGC, or the material uncertainty relating to going concern. The nature of the MURGC is it is still an EOM, but now it is given its own paragraph name. So it will no longer be labeled EOM dash going concern. It will now be labeled material uncertainty relating to going concern. But the purpose, the nature is still that of an EOM. It's kind of just like an elevated EOM because it now has a name, okay, on its own or for itself. Okay. So in this case, then, usually if it's an uncertainty, if it is an uncertainty relating to going concern, then we will be using an EOM that is now called as a material uncertainty relating to going concern. So this is alpha. Next, an auditor's objectives in evaluating counting estimates include all of the following except two. Letter A, provide reasonable assurance that management has developed all material estimates. Letter B, develop estimates and make the journal entries to record them. Letter C, assure that the estimates are reasonable. Or letter D, assure that the estimates are presented in the financial statements in accordance with GAAP. So which one is not part of the auditor's objectives? It will be to develop the estimates and make the journal entries. This one is the responsibility of management. The auditor, on the other hand, provides reasonable assurance that the estimates are reasonable, okay, and that they are presented in accordance with GAAP. So letter B is the responsibility of management, not the auditor. Next, under which of the following circumstances would a disclaimer of opinion not be appropriate? And we recall that the auditor gives a disclaimer of opinion if there is a scope limitation and if the scope limitation has an effect that is both material and pervasive. So let's look for the circumstance that would render a disclaimer to be inappropriate. Letter A, the auditor is engaged after fiscal year end and is unable to observe physical inventories, and the auditor was also not able to apply alternative procedures to verify their balances. Letter B, the auditor is unable to determine the amounts associated with illegal acts committed by the client's management. Or letter C, the financial statements fail to contain adequate disclosure concerning related party transactions. Or letter D, the client refuses to permit its attorney to furnish information requested in a letter of audit inquiry. So out of the four, there are three which are correctly scope limitations. For example, we can already identify letter A as a scope limitation. Why? The auditor was not able to apply audit procedures, not even alternative ones. So this is considered as a scope limitation. Letter B is also considered, or Bravo is also considered a scope limitation because of the inability to determine the amounts. So that is a scope limitation. Letter D, Delta, is also a scope limitation because the attorney, upon instruction of the client, refuses to reply to the letter of audit inquiry. There is only one here that is not a scope limitation. It is actually a violation of the standard, which would yield to misstatements, and that is letter C. Take note in the case of letter C, the financial statements fail to contain adequate disclosure. What does this mean? The standards require such disclosures, but the FSS fail to contain the disclosures. That means that there is a violation of the requirements of the standards. And this violation would lead to misstatements which would lead eventually to either a qualified opinion or an adverse opinion depending on the materiality and pervasiveness of its effects. So the answer to this one is Charlie. Next, management of Blue Company has decided not to account for a material transaction in accordance with the provisions of an accounting standard rather. In setting forth its reasons in a note to the financial statements, management has clearly demonstrated that due to unusual circumstances, the financial statements presented in accordance with the accounting standard would be misleading. So this is one of those rare instances where following the standards would actually lead to a misstated financial statement, or rather to a misleading financial statement. Okay, so this is one of those rare cases. The auditor's report should include an explanatory separate paragraph and contain what type of opinion? Is it an adverse opinion, an unqualified opinion, an except for qualified opinion, or a subject to qualified opinion? Now, we do have to remember that we have two accounting frameworks. We have what is called the compliance framework, and then we have what is called the fair presentation framework. So when we talk about compliance framework, the client only needs to comply with the standards, nothing more, nothing less. But when you talk about the fair presentation framework will start with compliance, that's the bare minimum, but then the client may provide more than what is required. And in rare instances, the client may also find it necessary to deviate from the requirements of the standards in order to ensure that the FSS are not misleading. Okay, so that's in the fair presentation framework. And our generally accepted accounting principles, particularly in the Philippines where we use PFRS, or worldwide where IFRS is adopted, The framework used is that of a fair presentation framework. That is why we say that the financial statements are fairly presented. That invokes the use of a fair presentation framework. It therefore allows the deviation from these standards in rare instances where following the standards might make the FSS misleading. So in this case, in the true fashion of a fair presentation framework, the auditor can still give an unqualified opinion. Okay, so this is the fair presentation framework. So bravo is the answer for this question. Next, in the Management Discussion and Analysis or MD&A contained in the 20X1 annual report of Derma Corporation, management stated the total sales were 4.95 billion and net profit was 500 million. The audited sales and net profit, however, were 3.8 billion and 450 million respectively. So notice that there is an inconsistency between the audited FS and the other information. In this case, the other information is the MD&A. The financial statements contained in the annual report reflected the audited figures, and the CPA planned to issue an unqualified opinion. This is one way of saying that upon investigation, it was found out that the financial statements bear the correct figures. Okay, so the FSS contain the correct figures. Upon noting the inconsistencies between the MD&A and the audited financial statements, however, the CPA should. Okay, so we do notice there is a difference between the other information and the audited report. However, the audited financial statements contain the correct balances. And so now what should the CPA do? Since the inconsistency or the error is in the other information. Okay, the FSS are okay. The other information is the one that contains the error. Letter A, refer to the inconsistency in the audit report and issue a qualified audit opinion. But remember, the FSs are correct. Okay, so it would not be fair for us to modify our opinion on the FS, right? When the FSs are correct. Letter B, issue an unqualified opinion without an explanatory paragraph because the MD&A is not covered in the audit report. The MD&A is an other information. But remember, according to PSA 720 or ISA 720, we do have to read the other information and be on the lookout for inconsistencies, right? Letter C, issue an unqualified opinion with an explanatory paragraph describing the inconsistency. Or letter D, render an adverse opinion on the basis that management had intentionally misrepresented reported sales and net profit. But again, do take note that the financial statements are correct and we give our opinion on the FS. And the FS contains correct balances. Therefore, the opinion that we can give on the FS should still be unqualified. And we just have to add an explanatory paragraph describing the inconsistency. If this explanatory paragraph simply describes the inconsistency without any reference to a particular note, then this explanatory paragraph should come in the form of an other matter paragraph. Okay? But in case the auditor wishes to draw attention to a note in order to draw out the inconsistency, then it may be an emphasis of matter paragraph. But generally, other matter paragraph. So, Charlie for this number. Next, after issuing the audit report, the auditor may become aware of information that would have affected the audit report had it been known at the time. Given discovery of such information, the auditor must take appropriate action. Which of the following actions would be considered inappropriate under these circumstances? And our choices are letter A, determine whether the information is reliable and whether the facts existed at the date of the audit report, because we do have to decide if this is a type 1 or a type 2 subsequent event, right? So we have to determine first if the facts existed at the date of the audit report and if the condition exists as of balance sheet date. Letter B, request the client to disclose to the financial statement users the newly discovered facts and their impact on the financial statement with financial statements with an emphasis on requesting the client to disclose. It should be the client who will make the disclosure. Letter C, if the client refuses to inform the third parties, then the auditor should notify the board of directors and regulatory agencies having jurisdiction over the client that the auditor's report can no longer be relied upon. Please take note that the auditor in this case is not disclosing the circumstances, okay, of this change or of this information, but rather simply notifies that the report cannot be relied upon. Or letter D, draft a revised audit report expressing a qualified or adverse opinion depending on the materiality and transmit the report to the stockholders. It is actually letter D that is inappropriate, because notice in the tenor of how choices A, B, and C are being said, we actually ask the client to make the disclosure. It is the client's responsibility to inform the third parties. Now, in instances whereby the client refuses to inform the third parties, that is the only time that the auditor will take matters into their own hands by looking at whether they have a responsibility to report to the regulatory agencies. Do take note that reporting to the regulatory agencies is not an automatic action of the auditor. The auditor will first have to determine if there will be no legal implications, particularly on our responsibility to uphold confidentiality. As such, before the auditor decides to report to the regulatory agencies, the auditor usually seeks legal counsel first. Okay, but it is very clear the auditor does not transmit the report to the stockholders immediately. Okay, the auditor will have to give the client the benefit of the doubt to make the corrections themselves first. So delta is the inappropriate action. Next, which of the following is included in the introductory or opening paragraph of the auditor's report? So we know that the first main paragraph or first main section of the auditor's report is the opinion paragraph, and the opinion paragraph is made up of two paragraphs. The first paragraph being the opening or introductory paragraph, and the second one is the statement of opinion. So which one is included in the introductory paragraph? Letter A, identification of the financial statements audited, including the date of and period covered by the financial statements. Letter B, a statement that the financial statements are the responsibility of entities management. Letter C, a statement that the audit was conducted in accordance with PSAs. Letter D, a statement that the responsibility of the auditor is to express an opinion on the financial statements based on the audit. Now, we are able to correctly identify that letter D should be part of auditor's responsibility section. Letter C is part of the basis for opinion section. Letter B is part of responsibilities for the FS section. So the only statement here that is to be found in the introductory paragraph is alpha, an identification of the FSS audited, including the date and period covered by the FS. So alpha to this number. Next, an auditor concludes that there is a material inconsistency in the other information in an annual report to shareholders containing audited FS. If the auditor concludes that the financial statements do not require revision, meaning to say the FSS are correct, but the client refuses to revise or eliminate the material inconsistency found in the other information. So the FS is correct. The other information is the one that contains the error, but the client refuses to correct it. What may the auditor do? Letter A, disclaim an opinion on the financial statements after explaining the material inconsistency in an emphasis of matter paragraph. But again, may I remind you, the FS is actually correct. There is no problem with the financial statements, and we give an opinion on the financial statements. So it wouldn't be fair to modify our opinion on the FS. So not letter A. Letter B, revise the auditor's report to include an EOM paragraph describing the material inconsistency. Let's park that to the side. Letter C, express a qualified opinion, and to that we say no, because we cannot, okay, modify our opinion because the FSs are correct. Or letter D, consider the matter closed because the other information is not in the audited FS. We cannot consider the matter closed as we have noted this inconsistency, and according to PSA 720, we do have a responsibility to read the other information and be on the lookout for these inconsistencies. So the only answer we have left here is bravo, revise the auditor's report to include an emphasis of matter paragraph. I would say that currently this is the best answer among the four. But if we are to make this one accurate, or if we are going to make this one really the correct statement, then the inclusion of an other matter paragraph would have been more appropriate. Okay, just to highlight the inconsistency. But then, of course, if the auditor wishes to refer to a note disclosure that might be the source of the inconsistency, then an EOM may also be used. Okay, so the answer to this one, the best answer to this one is bravo. Next, other matters to which the auditor may wish to refer to in an other matter paragraph, but which are not required to be presented or disclosed in the financial statements by the applicable financial reporting framework include, for example, the following, meaning to say which of these may be the subject of an other matter paragraph. The answer actually here is all three other choices. So Bravo, Charlie, and Delta are all or may all be subject to an other matter paragraph, such as, for example, in rare circumstances when the auditor considers necessary to communicate to the user, for example, when the auditor judges it necessary to explain why the auditor is unable to resign from an engagement. Okay, so the inability to resign from the engagement is not something we expect to find in the notes, right? As it is not related to the FS. But this may be something that the auditor deems necessary for the users to know. Or letter C, information in a document containing audited financial statements that is materially inconsistent with those financial statements. So as what we have been discussing for questions and other information, if there is a material inconsistency and the FS are correct, the material inconsistency is found in the other information, then we do use an other matter paragraph. That's the general rule. Use an other matter paragraph. Okay. Letter D, a predecessor auditor's report on the corresponding figures in the upcoming auditor's report for the current period where the incoming auditor is permitted to make such a reference. Take note, in this case, we are not dividing responsibility. We are simply informing the readers that prior to us, there was another auditor and this other auditor gave this opinion. There's no division of responsibility, just to point out that the prior year was audited by somebody else. Okay, so the answer to this is all three other choices. And to the next question, comparative financial statements include the financial statements of the prior year that were audited by a predecessor auditor whose report is not presented. Now, if the predecessor's report was qualified, so meaning to say the prior year contains a qualified opinion, the incoming auditor should, letter A, express an opinion only on the current year statements and make no reference to the prior year statements. But do take note that this auditor is presenting comparative FS. Okay. Letter A would say just ignore the prior year. That is what letter A is saying. Letter B, issue an updated comparative audit report indicating the division of responsibility. But then again, we cannot divide responsibility. In the first place, you are not sharing responsibility, right? The prior period is a separate responsibility. The current period is your responsibility. Letter C, request the client to reissue the predecessor's report on the prior year statement, but do take note that it is only the auditor who can reissue the report, okay? Because, well, after all, the audit report is the output of the auditor, not the client. Or letter D, indicate the substantive reasons for the qualification in the predecessor auditor's opinion, and this is, of course, the correct answer. This will be done by means of an other matter paragraph, where the other matter paragraph will disclose that the prior year was audited by another auditor. You don't have to drop names, no need to name names, just mention it's audited by another auditor, and then the date of the audit report, the opinion given, and if the opinion is other than unqualified, then the substantive reasons for the modification. So delta is the answer. Next, which of the following conditions or events most likely would cause an auditor to have substantial doubt about an entity's ability to continue as a going concern? We have actually answered a similar question in one of our previous parts here in round three, and we know that the answer to this one will be when cash flows are not able to generate. I mean, when operations rather are not able to generate cash, then that is an alarm for the entity's ability to continue as a going concern. So, bravo for this number. Next, if a lawyer refuses to furnish corroborating information regarding litigations, claims, and assessments, the auditor should, letter A, honor the confidentiality of the client lawyer relationship. Letter B, disclose the fact in a note to the financial statements. Letter C, consider the refusal as a scope limitation. Or letter D, seek to obtain corroborating information from management. Now, for this one, if the lawyer refuses to furnish corroborating information, this will be considered as a scope limitation, and depending on its effect on the financial statements, may even lead the auditor to consider issuing either disclaimer or qualified opinion. Okay, now again, please remember that it is actually management who is the primary source of information. We go to the client's lawyers for corroboration. Okay, so management is the primary source, the lawyer becomes the source of corroborating information. So if the lawyer refuses to respond, then it may be considered as a scope limitation. Next, in which of the following circumstances would a CPA be bound by ethics to refrain from disclosing any confidential information obtained during the course of a professional engagement? And this number will remind us of our responsibilities with regards confidentiality. And we are reminded that the information that we are able to obtain by virtue of our engagement with a client is confidential but not privileged. That means there are certain instances where we may be forced to divulge these information, such as, for example, well, a no-brainer would say when the client agrees or permits us to do so, when we are granted permission by the client, of course, we can disclose it, or when it is the subject of, or when the auditor is the subject of a peer review or a quality review. For example, in the case of the Philippines, we do have our quality assurance review. So this then becomes a professional responsibility. So if it's part of our professional responsibility, such as in the case of peer reviews or quality audit reviews, then you may disclose the information. Or in cases whereby you are subpoenaed by a court of law, then of course we provide the information. So amongst these four, when are you not allowed to provide the information? Okay, letter A, inquiry by a disciplinary body of PICPA or IACPA or other equivalent organization requests confidential client information, and letter A, you may disclose, okay, because it's part of your professional duty. Letter B, a major stockholder of a client company seeks accounting information from the CPA after management declined to disclose the requested information. So there was a stockholder, the stockholder went to the client refused, so the stockholder went to the auditor. Can you disclose the information? The answer is no. Okay, so we do have to observe confidentiality of information in this case. Unlike letters C and D, for example, confidential client information is made available as part of the quality review of the CPA's practice by a peer review team authorized by PICPA or the Philippine Institute of Certified Public Accountants or its equivalent, so that will not be considered a violation of confidentiality. Or letter D, the CPA was issued a summons or a subpoena enforceable by a court of law or a court order which orders the CPA to present confidential information. This is, again, not considered a violation of confidentiality. So, bravo is the answer to this question. Next, a CPA lawyer acting as a legal counsel. I think that's a wrong spelling, should be counsel. Again, a CPA lawyer acting as a legal counsel to one of his audit clients is an example of, and if you go to the Code of Ethics, this is an example of an advocacy threat, where the CPA is perceived to be promoting the position of the client. And definitely, because this auditor is also serving as the legal counsel, so seen to promote the position of the audit client. So this is advocacy threat. When a CPA compiles a non-public entity's financial statements that omit substantially all disclosures required by GAAP, the CPA should indicate in the compilation report that the financial statements are. Take note, this is not an assurance engagement. This is not an audit engagement. It's a compilation engagement. And a compilation engagement is a non-assurance engagement. It does not give any level of assurance. Okay? However, the auditor must state in the report that the FSs are, letter A, not designed for those who are not informed of the omitted disclosures. Letter B, FSs are compiled in conformity with other comprehensive basis of accounting. Letter C, not to be given to financial institutions for purposes of obtaining credit. Or letter D, restricted for internal use only. What will the compilation report include by virtue of FSs that omit substantially all disclosures? The answer is letter A. These financial statements are not designed for those who are not informed of the omitted disclosures. So the answer is alpha. And I think this is our last question for part four. This will officially seal off not just the 25 questions for part four, but the 100th question for the entirety of round three. Let's read this question. In order to address familiarity threat, which of the following is correct with regards the rotation of the lead engagement partner? Letter A, time on period of 5 years, cooling off period of 2 years. Letter B, time on period of 5 years, cooling off period of another 5 years. Letter C, time on period of 7 years, cooling off period of 2 years, or time on period of 7 years and cooling off period of 5 years. Based on the Code of Ethics adapted by the Philippines, currently we are adapting the 2020 ISBA Code of Ethics. The provisions of the code would require a time on period of 7 years and a cooling off period of 5 years. Now, this used to be an area of inconsistency as the Philippine SEC used to have a different requirement for time on, time off period, but now they are already aligned with the Code of Ethics. So we follow time on period of 7 years, cooling off period of 5 years, and mission accomplished, ladies and gentlemen. You have just completed part four of round three and has thus effectively completed the entirety of round three. So kudos to you, congratulations, a big hand to all of you for your hard work, and I continue to pray that all of your efforts be blessed. I hope to see you in our next playlist for the MCQ Marathon, but for now, I say a temporary bye.